If someone handed you $800,000 right now, and the only condition was that every dollar had to go toward assets that generate 3 times the monthly payment back to you, would you refuse it? Obviously not. But that's exactly what strategic debt is. Most business owners will never use it, not because the math is wrong, but because the word debt triggers something emotional that overrides the number entirely. I'm Ryan Chen with Loancater. I've personally funded over 300 businesses across construction, HVAC, medical, restaurants, trucking, and franchises. And today I'm going to break down exactly how strategic debt works, the mistakes that turn it into a death sentence, and the 3 numbers you need to know before you borrow anything. So next time a growth opportunity is sitting in front of you, you know exactly how to fund it, what it should cost, and what every borrowed dollar is going to return. Now, 82% of businesses that failed did not fail because the product was bad or the service was lacking. They failed because the cash ran out. That is from a US bank study, and it has held consistent for over a decade. The revenue was there, the demand was there, but the money in the account was not. And when you trace back why, it almost always comes down to one of 2 things. Either the business took on the wrong kind of debt at the wrong cost and got crushed by the payments, or the business avoided debt entirely, ran out of runway, and could not capitalize when the right opportunity showed up. That is the paradox most business owners never think about. Debt is both the number 1 reason business fail and the number 1 reason they scale. The difference is not whether you use it, it is which kind, at what cost, and for what purpose. And that brings me to something that actually explains why so many business owners get this wrong. Researchers published a study in Management Science, one of the top peer-reviewed business journals, and they found that 56% of people find taking on debt unpleasant. And let me make that clear, not financially wise, unpleasant. Like an emotional reaction similar to how you would feel about a bill you did not expect. And when the same researchers offer participants a guaranteed profitable investments, one where the return was mathematically certain, half of them refused to take it if it required borrowing money to fund it. They would rather miss a guaranteed profit than deal with the discomfort of owning someone. Now, just think about what that means for you as a business owner. If there is a piece of equipment sitting in front of you right now that would add $15,000 a month to your revenue, and the financing on it costs you $3,000 a month, the math says take it every single time. But more than half of business owners will hesitate because the feeling is uncomfortable. And the research shows that feelings is not even based on your own experience. It is cultural, it is inherited, and your parents likely felt the same way and passed it down to you without either of you realizing it. Now, I'm not telling you this to go make you borrow as much money as possible. What I'm telling you is that if your decision making around capital is driven by emotion instead of math, you are leaving growth on the table every single month, and you do not even know it. Because when that math is applied correctly, the results go back decades and they are not subtle. For example, Sam Walton, the founder of Walmart, started with $5,000 of his own money and $20,000 borrowed from his father-in-law to buy his first store in Newport, Arkansas in 1945. Throughout the 1950s, he borrowed from every bank he could find and used that capital to acquire one store after another. When he opened the first Walmart in 1962, he mortgaged his home and leveraged everything he had. By 1969, he had 18 locations across Arkansas and Missouri, all built on borrowed money. If Sam Walton had waited until he saved enough cash to open each store out of pocket, there will be no Walmart. Walmart is now the largest company in the world by revenue, but the math that built it is not complicated, and it works at every scale. A restaurant owner used the SBA 504 for $4.8 million to open his 6th location at a fixed rate of 4.3% over 20 years, and he kept leveraging each location to fund the next debtor. Same principle as Walton, just a different number. A dentist secured, let's say, $250,000 through a 7(a) to add another $35,000 a month in new revenue by expanding their patient pays through marketing by 40%. Same principle. And HVAC contractor launching his entire company with a $750,000 SBA loan covering the facility, the equipment, and his first hire. The principle is identical. Borrow at a cost that is lower than what the asset return and the debt pays for itself. Now, something I see all the time is that a contractor comes to us with $200,000 in cash on his own. That gets him 1 truck and 1 crew. But with an SBA loan behind it, that same $200,000 turns to 5 trucks, 5 crew, and 5 times the revenue capacity. Or you can use that same $200,000 as a down payment, borrow $800,000 on top of it through an SBA loan, and now you have 5 trucks and 5 crews doing work and generating revenue. That is leverage, and that is the reason Your competitor who started the same year as you with the same skill is now doing 3 times your volume with the same amount of his own cash. And if you are already thinking about what your capital options actually look like, that is actually what we sort out with business owners every day at LoanCater. There's a link in the description where you can fill out an application. Now our team will break down exactly what you qualify for, what your rates would be, and what your cheapest path to growth capital looks like. Now everything I just showed you is the upside of using debt correctly. But the reason so many business owners get burned is because not all debt is the same. And the difference between the kind that scales your business and the kind that buries it comes down to one thing: your cost of capital. If you borrow 8% and the money you deploy generates a 20%, you are pocketing 12% on someone else's capital. That is good debt. But if you borrow at 60% effective APR through a merchant cash advance and your margins are 15%, you are losing money on every dollar you take. That is bad debt. And the worst part about MCAs is that most business owners who carry them do not even know what they are actually paying. MCAs are structured with factor rates instead of interest rates. So 1.35 factor rate sounds manageable until you sit down and do the actual math. $250,000 at 1.35 factor rate paid over 10 months means you are paying $337,500. That is $87,500 in fees, which worked out to over 60% effective APR, with roughly $1,700 in daily debits hitting your bank account every single business day. And when those daily debits start squeezing your cash flow, the instinct is to take another advance to cover the gap, then another one on top of that. That is called stacking, and it's the fastest way to kill an otherwise healthy business. One company, Roger Landworks, ended up with 21 stacked merchant cash advances totaling $3.6 million before filing Chapter 11 bankruptcy. 21 advances on top of each other. I worked at one of the largest MCA brokerage in the country before starting LoanCater, and I saw this pattern destroy businesses that have plenty of revenue and plenty of demand, all because the debt structure was eating them alive. Which brings me to the 3 numbers every business owner needs to understand before they borrow anything. The first is your debt service coverage ratio, or DSCR. That is your net operating income divided by your total annual debt payments. The lender wants to see at least 1.25, meaning for every dollar of debt you carry, your business needs to be generating at least $1.25 in net operating income. If you are above 1.25, banks will lend to you. If you're below 1.0, you are spending more on debt than your business generates, and you are going backwards every single month. The second number is your cost of capital versus your return on that capital. That is the golden rule of strategic borrowing. If borrowing costs you 8% and the asset, if funds returns 20%, that 12% spread is pure profit on money that was never yours to begin with. As long as the return on what you borrow exceeds the cost of borrowing, the debt is working for you. But the moment that flips, the debt was working against you. And the third is knowing whether to borrow in your business name or your personal name, because this one actually has data behind it. A peer-reviewed study published in Journal of Corporate Finance revealed that businesses funded with debt in the company's name survived longer than earned higher revenue than those funded with debt in their owner's personal name. Debt in the owner's name had no effect on survival and was actually associated with lower revenue. The structure of debt matters just as much as the amount. Bear in mind, every single one of the example I walked through, from Walmart to HVAC contractors, borrowed in the entity name against the business asset and cash flow. That is what makes the difference. Now, there's one more piece to this that most business owners never think about, and it might be the most important takeaway from this entire video. The time to establish credit is when you do not need it. Banks lend to businesses with strong financials, clean books, and healthy cash flow. But when you wait until you are desperate, your numbers look weak, your negotiating position disappears, and you end up with the worst possible terms, which is exactly how people end up in the MCA spiral I just described. Right now, private equity firms are sitting on 2.51 trillion in what they call dry powder. That is capital they have staged and ready to deploy the second opportunity shows up. The best operator in every industry do the same thing at their scale. They establish a line of credit when their books are clean and their cash flow is strong. They get pre-approved before they ever need to draw on it. And when a competitor goes under and their best employees are suddenly available, or a prime location opens up, or a contract comes through that requires scaling up fast, they move while everyone else is scrambling to apply. The National Federation of Independent Businesses call a business line of credit an insurance policy that never needs to be paid until you need it. And that right there is the difference between businesses that grow and the one that watch the growth happen around them. Picture 2 businesses both doing $2 million a year, competing in the same market. One borrows $500,000 at 8%, adds 3 trucks, hires 3 crews, and starts bidding on contracts they could never have handled before. The other decides to save up for 3 years to do the same thing. By year 3, the first one is north of 4 million, while the second one is still at 2 million, watching contracts go to the company that had the capacity to say yes. The one who waited feels like they play it safe, but the one who moved is actually in a stronger position because they have the revenue, the infrastructure, and the cash flow to absorb anything the market throws at them. And that is the whole point. Debt is a tool. A hammer can build a house or break a window, and the problem is never the hammer. MCA is at 200% APR for covering next week's payroll. That is breaking windows. And SBA loans at 8% for equipment that generate revenue every single month. That is building your house. And the only thing that separates the business owners who build with it from the ones to get buried by it is understanding which is which. If you want help figuring out which capital structure should actually look like, this is what we do at LoanKitter. We look at your full financial pictures, your cash flow, your existing revenue, your real estate, your assets, and we engineer that capital stack that makes sense for where your business is at right now. Not just one loan, the right combination of products, rates, and terms built around your specific situation. Well, I've founded over 300 loans. We worked with 50 plus institutional investors, and we carry a 60% approval rates across our entire application base. So if you're interested in that, I'll leave a link in the description below where you can fill out an application. Now, our team will map out exactly what you qualify for and what your rates will look like and how much you could save every single month compared to what you are paying right now. Thank you for watching, and I will see you guys on the next one.